Fed Chair Jay Powell making the first move to fight inflation. What a round trip for the markets. Take a look at the S&P 500 right now. We are in rally mode after the Fed chair gave commentary, said expects every meeting to be live. In other words, we could see ongoing interest rate hikes potentially at every meeting this year. A lot of it was priced in. S&P is up 1.6%. It fell just before the news conference and then rallied right back. The Dow also trading higher right now, NASDAQ as well. If you look at what's happened in the bond market, it really tells the story. You saw yields shoot up immediately on the back of the statement. I think that initial 7 hikes per year, which was predicted by the dots or the forecast from the Fed, came as a surprise. But then as Fed Chair Powell started talking, those yields started coming a little bit lower. The dollar is weaker. Overall, taken as the market was pretty much expecting this. Joining me here at Post 9, former National Economic Council Director and former Goldman Sachs President Gary Cohn. Gary, welcome, especially after a big Fed day like this. Glad to have you by my side.
Thanks for having me. It's great to be in person.
Yeah, it's great to have you here. So first, give us your first take on what we just heard from Powell and the market reaction. It looks like a little bit of a celebration.
Well, I think you take 2 things out of this. Number one, I think the chairman kind of admitted he was behind the curve. And he came out. And
he didn't say it. He said, let others make that judgment.
I said he kind of admitted it. He admitted it by saying 7 this year, 4 in the following years. So he put 11 rate hikes on the table. And to me, that was, without ever saying I'm behind the curve, saying, OK, we've got some work to do ahead of us. But I also think by doing that, he has got the market in a position where he is now, as you said, put him in a position where every meeting is live, but every meeting being live means that he doesn't necessarily have to raise rates at every meeting, but he has prepared the market for a position where he could, if he wants to, raise rates at every meeting.
Do you think the next surprise could be actually they don't raise interest rates at every meeting?
Well, I think that's the position he's put us in right now. I think by saying every meeting's live and saying I'm going to raise at every meeting, he's probably put that optionality on the table. That's how I interpret it. I think that's how the markets have interpreted it. And I think they're interpreting it as, okay, he's admitting where we are. He's admitting where in many respects, he's admitting they're behind the curve. He's admitting where inflation is.
But why is that a good thing for the market?
Although the inflation number they put out is not one that I think they can get to.
Right, so they expect 4.1% at the end of this year.
Yeah, I don't think they can get to that in any way, shape, or form.
What would be a more realistic target?
Look, they're going to get help on inflation. They're going to get help on inflation because, as you know, the baseline is going to get better for them. As we get into the second half of this year, we started having a lot of wage and commodity inflation in the second half of last year. So when you look at the year-over-year numbers,
the comps get better.
The comps get dramatically better. Yeah. So literally by doing nothing except moving the months forward, our year-over-year inflation numbers are going to start looking better and better, whether he raises rates or not.
But you still think 4.1 is aggressive?
So I think anything with a 4 handle, it's pretty aggressive. I think he'd be lucky to see something with a 5 handle. It's probably somewhere in the high 5s, low 6s is what we're going to get. We still probably haven't seen the peak. You know, a lot of this volatility that's still in the system has not fed completely through. We've still got a lot of input inflation. We're going to see that on the commodity side. Everyone talks about oil. No one talks about the agricultural market. The agricultural market's probably more important
now. We're watching wheat
than the oil. It is. It's more important than the oil market. The oil market you can turn on, you can turn off. You get planting seasons in the agriculture markets, and if you miss the planting window, it doesn't reoccur. So the oil market is a little bit different. We're just talking about, can you ship it? Can you ship it out of certain places? Are you displacing oil from one market to another market? And I think we found that that's what's happening. That's why prices sort of resumed back to where it was sort of pre-Ukrainian situation. But the wheat market is completely different. You know, the wheat market, we're going to get one planting season.
Jay Powell can't do anything about the planting season. Dow's up 333 points. Gary, stay with us. Do want to get to Steve Leisman, who was part of Fed Chair Powell's news conference. Steve, what were your big takeaways?
I would just like to say that I am sure that Fed Chair Jay Powell hopes Gary Cohn is right, and they do get some help from a lot of sources. That was part of Powell's presentation. Sarah, I was struck by the change in the forecast. I don't think you can help but being struck by that. The fact that the median Fed official now sees restrictive rates for the next 2 years. And as I said in my question, the Fed still doesn't catch up. Inflation still runs, according to their own forecast, above their target for 2 years while they're restrictive and above the neutral rate. So Powell kind of hinted at this, but you have to be on your mark now. As hawkish as this was, as the idea that a decision to hike the balance sheet is probably coming in May, Powell also was, not shy about saying, hey, we might do some 50s. We might go faster. Take a listen.
We'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting. And if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Might be by the summer before they conclude that. Just take a real quick look, Sarah, at the probabilities. What you see here is real firm confidence that the Fed hikes the next 4 hikes and a little bit less. But really today, Sarah, those 7 hikes that are in the Fed forecast, those are priced in. And that December hike was priced in almost immediately. Maybe Gary Cohn is right about that. They don't get there, but that's where the market's priced right now, Sarah.
Steve Leisman. Steve, thank you very much. So ultimately, how many rate hikes do you expect this year?
Look, I don't know. It's really going to depend on where we head with inflation. I still think we've got inflation in the system. I'm more concerned about the wage side of the equation. If you look at the data at the end of last month, we still had 11.3 million unfilled jobs. The labor market is tight.
Yep.
When I'm out talking to
Powell referenced it.
Yeah, when I'm out talking to CEOs and we see it every day, their biggest issue is hiring people and retaining people, and we see it in the data every day. And that's the biggest restraint on companies today. You've also got the supply chain issues. The supply chain issues are not freeing up anytime soon. And so those
are getting worse in China.
Well, with COVID going on right now, we don't know what's going on. But clearly shutting down some of the cities, some of the important cities that export technology in the United States, it could be getting worse.
Here's another thing that Powell said that struck me. He said that the economy was well positioned to deal with the rate hikes and said that recession risks are, quote, not particularly elevated. All signs the economy is strong, which is certainly soothing and reassuring to hear. But is it right?
I agree with that. I agree. Look, consumer balance sheets were in great position coming into
You
this.
never think we're in. Gary texts me every time I'm on saying, stop talking about recession. We're not going into recession.
Have I been right so far?
You've been right.
Okay, good. So eventually I may be wrong, but I may change my mind.
No, I mean, it is
so look,
moving against you.
Consumer balance sheets, corporate balance sheets are in really good position. So you look at that. You look at wage growth, especially at the bottom quintile, bottom quartile. Wage growth has been very, very good. And as I said, there's jobs available. So if you look at what's going on and you look at what's driving the economy, I think we're still in very sound footing. I think Powell was right. If we're ever going to be in a position to deal with increased rates, it is now. And believe me, it has been telegraphed. The market, as you said, you opened up talking about how the market was prepared for this. The market accepted it. The stock market's rallied. And rates are about where we would have thought they would be at the end of the day.
Even with, though, the situation in Ukraine, the fact that Russia's cut off now from the global economy, which has stronger ripple effects on Europe, which is now risking a 3rd recession in the last 2 years, and will certainly affect us.
It will.
Think we can handle it?
Look, we can handle it. It's clearly going to have an impact. It's clear we can't discount what's going on in Ukraine. It's a horrible, horrific situation, and no one should discount it or put it to the side. But from an economic standpoint, we in the United States here are in relatively to very good position. We've got supply chain issues. We've got other issues. We've got the wheat issue. Ukraine, Russia is clearly in the middle of the wheat issue. They're in the middle of the nickel issue. They're in the middle of a bunch of the other commodity issues. They're all going to have an effect, and they're all inflationary effects. But we are in a strong enough position, and I think we're resilient enough to get through this.
So does that mean that stocks are a good bet right now? The fact that they've priced in all of these hikes that Powell is talking about, and you don't see us going into recession?
So, Sarah, that's a different discussion. So roll the clock back to when we went to easy monetary policy, and we went to zero rate policy. We went to very accommodative. What happened?
You're talking depths of COVID.
Yeah. No, I'm talking before that, way before that, way before that.
Financial crisis.
Go back years when they first started. What happened? We saw companies do very well, and we saw their stocks do extraordinarily well because there was no place for people to put their money. So we saw multiple expansion. You could see a company earn the same amount of money year 1 and year 2, but their stock value would go up. What happened? The multiple of that company went up. It was going up because There was no real other alternative where to put your money. So we saw multiple expansion for many, many years. We are now starting to see the opposite effect. As we've started to talk about Fed tightening, and we're starting to see alternative places to put your money, risk-free rates going up, credit spreads widening, investors have alternative places to put your money. So what are we seeing? We're seeing multiple compression.
Yeah.
Multiple compression is painful. It really is painful. Companies are doing well. You see it every day. In the last couple of days, we've seen the airline industry talk about how they can sell every seat. You saw Uber talk about how well they're doing. We're not hearing about companies telling us they're doing poorly. We hear about companies coming on telling you how well they're doing or pre-announcing. So companies are doing well, but we're seeing this multiple compression because the Fed is starting to go to a tightening policy. That means we have to figure out what multiples should be based on where monetary policy is going to be. That will determine whether you should buy stocks or not.
Does that mean you wouldn't be in tech stocks right now, for instance?
Not necessarily. I mean, tech stocks are a generalization. Some of the tech stocks have gotten to relatively cheap multiples. Some are still at very high multiples, and you've got to look at growth rates. I think you've got to get back to looking at individual stocks and looking at where their multiples are, looking at their growth rates, looking at their historic multiples, and understanding what fair value is.
Are you still heavily invested in stocks, or have you moved to cash?
I got out of some of my portfolio at the end of last year, maybe for the wrong reasons, maybe for the right reasons, but I definitely got out of some of my portfolio last year.
Gary Cohn, great to have you here
Sorry.
on the Fed Day. Thank you.
Thanks for having me.
Bank stocks, take a look, significantly outperforming the market today. They like the sound of higher rates. Up next, we'll hear from an analyst on the best way to invest in that space following the Fed decision. And you may be surprised by his top picks. That story and more when we take you inside the market zone. And remember, you can listen to Closing Bell on the go. Following the Closing Bell podcast every day on your favorite podcast app, Dow is up 291. We've really rallied off the Fed news presser by Fed Chair Jay Powell. We'll be right back.